Oh, Tristan, welcome, welcome, welcome. I'm going to put some headphones in so you can ask questions and I can hear you and whatnot. Let me know if that camera angle doesn't work for you. If you can't see the board too well, double click my screen. It will go full screen for you. I might move that over just a little bit more. Doesn't look too bad. If you can hear me just fine, you can put it in the chat. But I'm gonna put some headphones in so you can directly ask me questions once we get going here. Especially if you can't see something, just let me know. Perfect. All right. So hopefully you can hear me a little bit better now. Excellent. Excellent. All right. So as promised yesterday. So as promised yesterday, I found a policy from one of our insurance companies for if you're married, you have a different policy. If you want to fill out your policies single or together as a married couple, you'd actually save a little bit of money. Now, this is full coverage, mind you. These are for adults over, I think it's over 21. So I don't think they even considered 18, but it was over 21. Some of these are pretty big policies. They cover a lot. It's full coverage. They didn't even put in consideration. They didn't put in consideration a high risk or low risk. They just give me an average. And then what they did is they compared to different companies. And they didn't want to list the companies, so they just listed them A through L. So that was really nice of them. They did not need to do that.
Do you want us to write this down?
No. So I'll share this with you later. I'll probably email it to you here in about 10 minutes. So Tristan, if you can't see these numbers, you're probably going to get it in about 10 minutes once we get going here, so you can kind of see it. Okay. All right. So I'll zoom in here in a minute once we get to one that we want to use. All right. So here's the idea. So this is a 6-month policy. It's what you're paying every 6 months. If you're going to be just the male alone on the policy versus just the female alone, even though they're married. So if they're going to buy their own things, like me and my wife have separate policies. She has her own policy for her car. I have my own policy. We don't go together, right? Because I don't drive her car at any point. That's the way our little arrangement works. Like she has her car, I have my car. If we go anywhere, the person if we're riding in one or the other's car, they're driving their car. I don't know why, it was a system that works out for us. We don't have to worry about changing the seat positions and all that other stuff. But look at this. I want you to just see this. Somebody over 21. I'm going to zoom in on this, just so everyone can see this. There is a difference in the average policy between a male and female. Same age, 21-ish. Okay? So in fact, I'm going to super zoom in on that. All right. Where is my cursor? There it is. I'm going to super zoom in on that. Male, female, same policy, same vehicle. This policy was based on a Toyota Corolla 2020. Toyota Corolla. Okay, they had the same policy, full coverage. It was I think the policy was, it was really big. It was like 50, 75, 20 or something like that. Let me open it up. I need to see which policy it was. It was a 25, 50, 25 coverage. So 25, 50, 25. I cut that off the bottom. Okay, that was the policy coverage on this one. Okay, now I highlighted a couple things on here. I quickly highlighted. I want you to see if you were to, buy the policy separately. Okay, so buying the policy separate versus if you bought them together. If you had insurance on both vehicles at the same time, you saved, what was that, like $400. And you're thinking, Ward, you just told me you and your wife are on separate policies. Yeah, that was an average. What you're looking at here, this first column, that's an average between all the companies, A to B to C to D to E, right? That was like, some of them saved you, $300, some saved you $200. The company we go with, we went separately just because of the vehicle itself. It was just for us, it just made more sense. We're paying separately. But yeah, you can definitely see. Now, the reason why it goes cheaper when you have it rated together is because what they do, and this is the trick, they place the female as the person that's the primary driver of that vehicle. So it lowered the insurance. That's what they did. It's a quick policy. In California, what people do to lower their insurance rates, they buy a super, super cheap economical vehicle, and that's what they say is their main vehicle in California. So what they'll do is they'll buy a smart car, like a really tiny smart car, and say that's their primary vehicle, but they never drive it. They drive their BMW, because what it did is it lowers their insurance rate because the BMW is not their primary vehicle. So they go with a more economical car, and it lowers the insurance big time. Other states don't do that. You pay per coverage. But this is full, so you can kind of see the difference in companies. Look at this. Same policies. I'm just going to scroll across this. Same exact car, same coverage between different companies. Look at this. It was like Farm Bureau, State Farm, Geico, Allstate. There was a bunch. And they luckily took the names off. I don't want to get sued by some company. So here you go. They're all over the place. There's certain companies here. Look at this. I want you to notice this. Company F. Company F. Female was more than the male. That doesn't happen too often. That company had it. It was different. Later on, Company H. They had the same policy. I think that was Geico, if I wasn't mistaken. Don't quote me on that. I think they had the same policy for male and female. This one was cheaper again. There was a couple cheaper. And some of these were like ones I've never heard of in my whole entire life. So I didn't even want to even venture off to that. But here's some different policies, right? So you can kind of see it. I even have the money that you saved. I subtracted it so you can see it. I made the chart. And then percent saved if you were to go together as opposed to separate. So you can see how much money you'd actually save. Some of these you wouldn't save anything if you went together. There would be hardly a change. But like 10, 15%, like those are really low. The ones with 24, I would definitely say like on 24%, you probably want to go together on a policy if you have a female and a male. But yeah, so just kind of interesting to see different companies' approaches. This coverage, again, this is full coverage, 25 payout per person per injury, total of 50,000 paid out for the entire accident for injuries, and 25 for any property damage. That was pretty standard. Now the deductibles on this, what I mean by deductible, you have to pay an upfront down payment when you first get in the accident, if you're the one, if you're the one at fault. To get your stuff automatically fixed and stuff, it's a $500 deductible, and that's pretty standard. I didn't realize for a long time when I was in high school, I was paying for insurance and I had a zero deductible. I never even knew it, that I did that. That means if I got in an accident, I wouldn't have to pay anything out of pocket. But I was also paying a lot of money for insurance, and I didn't even realize I did it. So it's super nice. It was super convenient when I actually did get in a car wreck. And the worst part was I wasn't even in the vehicle. It was in a parking lot, so we ran into the back of me. So I didn't have to pay anything out of pocket. They took care of it, and my car was fixed. And it was only gone for like a day or two. It was just a bumper, just needed to be fixed. It was super easy. But yeah, it was one of those things like, sometimes you got to worry about those little things. Like, can you imagine getting in a little fender bender and you have to pay $500 deductible, and maybe the damage wasn't even that bad? Like, my bumper didn't cost anything to fix. Okay, but I want you to see these. I had a couple different companies that I picked. There was a lot, but there were some I never even heard of, so I just kind of put those at the end. But yeah, some of the bigger companies I put up front. All right, questions with the insurance policies. Okay, now, one of the other things we need to talk about today, okay, not this, but one of the other things we need to discuss. And I forgot to bring this up the other day. I was going to talk about it yesterday, right when you guys were here, because your assignment that you have due, that was due, what, tomorrow? We have page 121 is due tomorrow. That one's based on insurances. But the thing I forgot to cover yesterday was we had a worksheet 5.2. That was the based on if you took out a loan, like a small interest loan for a vehicle. I forgot to go through a problem if you make a down payment, what that would do to your payments. And I forgot to talk about that. I said I was going to do it because it wasn't a part of the homework, but I think it's important we talk about it. So I want to cover that today. This is going to actually be one of my last few problems today. That's all I want to talk about today. I want to talk about insurance so you can see different numbers, and then talk about what this would do. So here's the idea. So let's say we're taking out a small loan. I'm going to use my first truck as the example. The first truck I ever bought. My first truck was $5,600. Little S10 pickup back in 1996. Long time ago. $5,600. And I took out a loan for 4 years. My interest rate was 3.2%. That was my interest. It was really good at the time. I had, the interest rates at banks were really low at the time, and I was a first-time loan person, so I didn't have any credit with the bank yet. So my interest rate was pretty good for having no credit established. Now, I want to talk about what this would cost in the long run and what my monthly payments would be. Right? I'm going to do that right now. Then I want to talk about what would happen if I would have made a down payment on said vehicle. What would have that done to my actual payments? Okay? And that's what I want to finish with. I want to finish with two problems. Okay? So let's do the math here. So to figure out what I paid total for this vehicle, again, this is the formula that we used on that worksheet earlier. It was this one, right? That was a little simple interest formula. You take whatever you're borrowing, the principal, that's the $5,600. You're going to take it times the rate, 0.032, and then you take it times the number of years, right? 4 years. So if we multiply these together, this will be the extra payment, the amount that I'll pay the bank extra to take out this loan. Okay, so if you guys have calculators, that'd be great. To fire up the number, what do we get?
16.80.
0.80. Okay, so $716. Okay, that was my loan. That was the extra payment. So my total that I paid for the vehicle in 4 years, total that I paid, would have been the $5,600 plus the $716.80. So my total that I would have paid would have been this. Let's see, that's a 6 and a 1 and a 3 and a 1. $6,316. Is that what it was? $6,316.80. So somebody double check my math. I can't admit it. Is that right? 6,316. Yeah. Okay. I'm praying that's the right number. Okay. Now, that's what I pay total. If I want to figure out monthly payments, you divide by 4, divide by 12. I don't really care about that. Okay. I just want you to see what I'd pay total for the vehicle. Now, down payment. Down payment. We'll come back to the monthly payments here in a minute because that might affect you. Okay? Let's say we make a down payment. Let's say instead of buying the vehicle right off the bat, for $5,600, right? Take out a 4-year loan, 4 years at 3.2%, right? Still going to have the same interest. But now I'm going to make a down payment on this vehicle. So let's say I worked a few months during the summer and I saved up $750. $750. Okay? So I'm going to make a down payment when I go into the car dealership. I'm going to say, hey, I'm going to write a check to you for $750, and that's going to come off the top. And then what they'll do is after I make that little $750 payment, then they're going to calculate what the loan is. Okay, so I'm going to subtract $750. So can somebody do that for me right off the bat? I think it's like 4,000 something.
4850.
4850? Okay. All right, so this is the loan that I'm actually taking out. I'm taking out a $4,000 loan. Okay. $4,850. and then I'm gonna do all my normal math that I just talked about, right? 4,850, I'm gonna take it times the 0.032 times the 4, right? This will give me my amount total. What do I get when I multiply that? 620.80. Okay, like that. So that's the extra that I'm paying the bank to take out this loan. So the total that I'm going to be spending on this vehicle, 4,850. I'm going to add the $620.80. So if I add those together, I should get 80. Let's see, that's a 70. That is a 14, carry a 1. That's a 5.
Yeah.
Sorry, I totally had a brain meltdown there for a second. All right, so it's $5,470.80, right? Does everyone agree with that?
Yes.
Okay, so that's what I'm paying over 4 years for that loan. Now, that's just the loan that I'm paying. What was the extra check I wrote at the very beginning of that loan? $750. Okay, so I wrote $750 check. So this is what my loan would have paid over 4 years. But in the very beginning, I also wrote a $750 check to say, hey, I'm going to give you a down payment to show good faith, to bring down my payments a little bit. And so if I add that back in, this is what I actually paid for the vehicles. Because I don't want to forget the down payment. That was still a part of the payment I made, right? This is what I paid total for said vehicle.
So the down payment was $750.
The down payment was $750, right? That was my down payment, yeah. In fact, I'm going to label that. That's a good thing to label. This is my down payment. Same car, same everything. I just saved a little bit of money, maybe before I bought it, and I made a $750 check down for it. But do you see that I paid less money for my vehicle? In the long run, overall, even when I was buying the same vehicle, I took out the same loan. It just the amount was a little bit different in the very beginning. But when I added my down payment back to what I paid for the vehicle total, I saved what, about $100? You're like, oh, that ain't worth it. You saved $100 because you waited a few months to buy the car. It's the same vehicle. I paid overall less money just because I saved a little bit, and then I made a down payment for that vehicle. It was cheaper to buy it just because I waited. Now, what also would have helped if I waited maybe a year, I would have had more money. Plus, the car would have depreciated further. So maybe I could get the vehicle for less than $5,600. So then I'm saving even more money. So that's the thing I want you to think about. So, when I told you guys I was really interested in buying a car, which I am, I'm very interested in buying a certain type of car. I'm also thinking about long term is like, I'm saving for this vehicle because I know what down payments will do for me. They'll make my payments less, number one. You can see that I'm paying less for the vehicle. Plus, my payments are less, and I'm getting the same vehicle for a cheaper amount of money. It's just a smart decision. You should always attempt that. If you can save up straight cash and buy your vehicles without having to take out a loan, that is always the preferred method. You'll save a lot of money. You won't have to pay the extra cash to the bank. The 620 or the 716. So it's always a preferred method. But it's not realistic sometimes. You can't save up that much, or you can't wait that long because you need that vehicle to get to work sometimes, especially in the winter. All right, questions. I think this is an important thing to see. To see the importance of learning how to save money is an important topic. Okay, that's it for today. That's all I got. Tristan, thanks for tuning in.